Hi there, Colin Hall thinking out loud. Something that's been getting a lot of column inches and airtime recently is the idea of a wealth tax. Now, if you're not sure what a wealth tax is, a tax on wealth is something that taxes the value that you hold, not the money that you earn. So most of us who are salaried or self-employed, as we earn money, we pay tax on it. But the assets that are owned, shares in companies, property, land, other assets, we don't pay tax on those simply because we own them. We pay capital gains when we sell them. We may pay income tax on dividends, but by and large, it doesn't really matter how much assets, how much wealth you hold, you're not taxed on it. And there are some people that think that is unfair. And I have sympathy with that position, particularly when the increase in value of those assets has got nothing to do with the hard work put in by the individual. So if I bought a property 10 years ago and it's now worth double, I did nothing to create that additional value. I just sat on an asset and watched it accrue in value. So I do have sympathy with that position. However, it is the job of the Chancellor to optimise the amount of revenue, maximise it without damaging the economy, because long-term future growth is more important than short-term revenue. So let's look at the actual numbers of a wealth tax that's been proposed and see whether or not it works. So the numbers being bandied around is £10 million of assets or higher and a 2% rate. So if you own assets of £10 million or more, you will pay 2% on the value of those assets. So if you own £100 million, you'll pay £2 million in tax. It's nice and easy maths. And they've calculated, or it has been calculated, that if you look at the number of millionaires in this country whose assets are worth 10 million or more, that would raise you about 11 billion pounds. It's a lot of money. However, the size of the hole facing Rachel Reeves this year is between 20 and 50 billion pounds, depending on which forecast you believe. And with the cost of government with things like the NHS, welfare, pensions, etc., due to rise at a rate of about 4% a year for the foreseeable future, and with the economy only growing at a rate of 1%, that forecast, that gap, is just going to get bigger and bigger and bigger. And so if 11 million pounds won't close it in year one, it's not going to close it in year 2, 3, 4 or 5. So other taxes will be required. And that all assumes, of course, that all these millionaires just sit there and pay it. And the one thing we know about taxes is that they generate incentives. Incentives to do things, incentives to not do things. And if you think that all these wealthy millionaires are going to just sit there and just pay taxes, then I'm sorry, you're delusional. Absolutely no way that if they can get around paying it, they won't find a way. Of course, there will be one or two and say, I'm happy to pay it, make my contribution, but enough of them won't that you'll get nowhere near the 11 billion. And then you'll have to tax other people even more. And that, of course, assumes you can figure out a way to do it. Now, that sounds simple. Well, just take their wealth and multiply by 2%. Yes, but how do you calculate the wealth? If you own stocks and shares, you can look at the stock exchange and say, there's the value. But that's a live number. It's constantly changing. So at what point do you take that value? Is it on tax day, first of the year? Is it an average over the year? How do you calculate that number? Because you can guarantee that some people will get a tax bill after shares have dropped because owning shares is risky, and the tax bill will be bigger than the value of the shares themselves. And then what about things that aren't publicly traded, where there is no price that you can refer to? What about the value of land and other assets? How much is an art collection worth? How much is a wife's diamond jewellery worth? These are subjective numbers to a huge degree, and there are lots and lots of ways you could argue how to value them. Each have their pros and cons. And as soon as you start putting numbers against this against wealthy people, they will have you in court and tie you up for years. In short, a wealth tax is a pain in the arse, doesn't generate much money, it misdirects actions away from wealth generation and into other areas, and they'll just leave. So that's why a wealth tax isn't going to work. It may make you feel better, it may make you think it's fairer, but it'll also make you poorer. And frankly, I think one's more important than the other. Ta-da for now.